In the world of trading, you have likely heard things like
Trading is a scam.
It's a waste of time.
or
Being profitable is impossible.
but here's the truth. While it's challenging, it's absolutely possible to succeed in trading. If some can do it, so can you. The key? Proper education. And sorry to say, but much of what you find online today is misleading. But that's why I'm here. My name is Sam, but you can call me ATP, and I have dedicated myself to mastering this market. I have studied extensively, including completing certifications at Oxford and other respectable institutions. Over the next 5 weeks, I will be producing a trading bootcamp on my channel, a free crash course for those who truly want to master trading in the best and simplest way possible. Each week, I will release a new video covering theory, risk management tips, and a precise practical method for building a profitable trading system, all proved in real time. So subscribe now and get ready, because this is where your trading success begins. At the beginning of each episode, I will expose one trading myth that will then be proved throughout the video. Today's myth is trading is gambling. While trading and gambling both involve risk, they are fundamentally different. Gambling usually relies on chance with outcomes heavily influenced by luck, while trading involves analysis, strategy, and risk and emotional management. When these qualities are aligned, you can achieve what's called a trading edge. In the course I completed at Oxford, a market edge was defined as an advantage over others in the market achieved by creating a system that, over the long run, consistently gives more profits than losses. This is a crucial distinction between gambling and trading. In each episode, I will address other myths, so if there is a specific one you are interested in, leave a comment and I will cover it in the next episodes. So, as I told you, to be profitable at trading, you need to have an edge in the market. And to have an edge, you need to have a system. Not just a technical analysis one, but also systems for risk management and emotional management. These are the 3 columns that are essential for any successful trader. Firstly, let's discuss the technical system, which we'll focus on extensively during this bootcamp. This system includes all the methods or rules that guide our decisions on when to enter and exit trades. Today, we'll start addressing this first column. Next, we have our risk management system, crucial for controlling our risk and maximizing the potential of each trade we enter. A good risk management reduces losses while maximizing profits from every trade. It sounds simple, and it is, but I will only delve into this topic in episode 2 of this bootcamp, so on the next week. Lastly, we have the emotional management, which provides the support to apply our edge consistently and without hesitation, which we'll talk more about in the last episode of this course. Let's then go back to the first column, the technical system. I remember, the key here is to establish a set of fixed rules that guide our trade entries and exits consistently. You can create this system based on price action, fundamental analysis, or using indicators. There is no right or wrong approach, because the system should always be created based on your likings. And how do you know if our system provides an edge? It's quite simple, through backtesting over a large data sample. Backtesting involves applying a strategy to historical data to assess its accuracy, while a data sample refers to historical price data used to develop and optimize a trading strategy. If a system proves efficient and profitable over a significant backtested data sample, then we can say we have identified an edge in the market. In this bootcamp, I will teach you how to build an indicator-based system, like I learned in my certification at Oxford, which is the best option for beginner traders. However, the principles I will share apply to any other type of strategy. Firstly, it's important to define the time frame and assets we want to focus on for our system. If you have more time for trading, you can use shorter time frames, like the 5 minutes or 15 minutes. On the other hand, if you have less time, the 4-hour or daily time frames are suitable. In my case, I will choose the 1-hour time frame. Now, regarding assets, you can develop a strategy for a specific market or multiple markets. Diversifying across assets is beneficial, much like investing in stocks from different sectors. Therefore, I will opt for a strategy valid to Forex, crypto and metals. When selecting assets for the backtesting phase, I recommend choosing at least 5 different ones to avoid overfitting to a specific one. Overfitting in trading happens when a system is designed so closely to historical data from one asset that it becomes ineffective in the future. For my strategy, I will choose 3 Forex pairs with different currencies, AUD NZD, Swiss franc JPY and Euro USD, and then Bitcoin and also gold. As you saw on TradingView, which is a trading platform I use, I can create a watch list with these exact assets by inserting them on the chart, then clicking on the screen with a right mouse click, selecting the option Add to Watch List, and then here I can drag them to create a specific section. Regarding the data supplier for each asset, I choose the ones from top brokers, but you can use the ones from your broker to get more precise results. These assets will be used in the backtesting phase, but you can add others from the same markets later when you have your strategy created. After making these initial choices, we can start working on our system. A good indicator system not only tells us when to enter and exit the market, but is also composed of indicators with different functions. Trend, an indicator to assess the market direction, momentum, an indicator to assess trend strength, volume, an indicator to analyze the quantity of trades occurring in the market, and volatility, an indicator that measures the intensity of changes in an asset's value over a specific period. And it's important to have at least one indicator of each type to make our system as comprehensive as possible. The first indicator we should analyze, test and choose is our entry or primary confirmation indicator, the C1, which will be a trend or momentum indicator that will tell us precisely when we should open a position, either long or short. And today I will work with you together on that. Then in the next episodes we will discuss exit, volume and filter indicators that will improve the efficiency and profitability of the signals. To discover the best C1 indicator for our assets and time frame, we need to test several different indicators under the same conditions, compare the results and select the most effective one. And to ensure that the good results are not just luck, I prefer to work with 2 data samples, an in-sample data and an out-of-sample one. The in-sample data is where I apply all the C1 indicators I want to test, while the out-of-sample data will be used to apply only the top indicators identified during the in-sample phase. This helps ensure that the indicator's performance remains consistent and protects us against overfitting. Selecting these 2 data samples involves checking the available data range. On TradingView, you can find out the available data by clicking on the Go To button, entering an earlier date and clicking on OK. In my case, as you can see, the available data for Bitcoin in the 1-hour time frame starts in 2022. And please note that you may have not the same data if you are using the free version, because I use the TradingView premium one. However, if you are interested in accessing more data, you can subscribe to one of their plans using my link to get a $30 discount, which can be very helpful. Once I confirm that my other 4 assets also have data available from 2022, I will split my data into 2 samples as follows. The in-sample will consist of the 2022 data and the out-of-sample will cover the data from 2023. Now, the next step is to conduct backtests on different indicators. To conduct these backtests effectively, we need 2 things. First, we will need to insert the indicator we want to test on our charts. This process is straightforward. Simply click on the Indicators tab, choose the indicator you want to test, for example the super trend, and click on it to apply it to the chart. If you have any questions about how to use a specific indicator, you can send a message to my free community and one of our members will help you. My Discord link is in the description. Secondly, we should have in mind where to place a stop loss and a take profit. The stop loss you define should be consistent and based on market volatility. For this, I will use the ATR bands indicator, which help us establish the appropriate stop loss level based on market volatility. I will adjust the multiplier to 2 to set my stop loss levels. For long positions, I will place the stop loss at the red line, and for short positions, I will use the green one. And this is the stop loss I advise you all to use. As for the take profit, it's important to note that on the testing C1 indicator stage, the level you choose will only be your first level to take note of the win rates, and you will understand why next week. In my case, I will use an initial risk-reward ratio of 1:1 for simplicity during testing. So, for long positions, the take profit will be at the green line and the stop loss at the red one, and the opposite is true for short positions. And of course, you can use different methods like fixed pip targets, swing highs or lows, or other criteria according to your tastes. Now we'll go back in time for each asset and conduct our backtest. To easily track and analyze trades, you can use a spreadsheet like Excel. Organize your data by identifying the indicator name and settings. Then create a table where you record the asset, entry date and outcome in percentage terms like -2% for a loss and +2% for a gain. Then you can calculate the overall profit loss and win rate automatically. For profit loss, use a simple sum formula, and for win rate, count the number of positive outcomes using the count if formula and divide it by the total number of trades, which are the sum of the positive outcomes and the negative ones, which I also calculated using the count if formula. Convert this to a percentage and you will have the indicator's win rate. Now what you need to do is replicate this process for several indicators, and you can also test them with different settings. The idea is then to compare all the results to identify which trigger indicators had the highest win rate and net profit according to your conditions. This process can be time consuming, but it is the right way to do it. However, for my new 1-hour time frame strategy, I prefer to speed up the backtesting process, and for that I rely on a tool I developed specifically for this purpose. Let me introduce you to the indicators testing bot. This tool allows me to customize data samples, risk management settings, and select indicators for testing. I can even define in which trading session I want to trade and create my own session according to my available time to trade. Then, within seconds, I can see all the trades marked on the chart, along with their respective stop losses and take profits, and analyze the monthly results of this table or the overall ones on the Strategy Tester tab. After setting the data sample for 2022, setting up the risk management based on the ATR and selecting the super trend as the C1 indicator, I simply click on OK, and here are the results of this currency pair. Likewise, when I switch to gold, the trading bot quickly applies the strategy and provides the results in seconds. This fast backtesting process not only rushes our analysis, but also generates highly accurate and proven results. And the best part, this tool is also available for everyone. Check out the description for more information about it. So, in my case, I will simply copy the information for each asset presented in the strategy tester into a simplified Excel table, just like you see here. And I will take not only note of the profit loss and win rate, but also of the number of trades and the max drawdown ratio, which are metrics that I will use to compare the results from every indicator in a more efficient way. I will repeat this process for multiple indicators and settings using my indicators testing bot and only using the in-sample data. You can perform the same process manually or choose to use this tool as well. Currently, there are 50 indicators available for you to use, with new indicators added every week. I will accelerate the backtesting process and show you some clips of it. But you have the option to adjust the speed in the YouTube settings to check how the bot operates. I'll see you again once I have completed all the in-sample backtests. After analyzing 100 possibilities with different indicators and settings, I have compiled them all into this table to have the final results organized. And you can do the same by copying and pasting all your results, or by using the shortcut equal, then pressing the Ctrl and page down buttons from your keyboard, and then selecting the corresponding result, just like I am showing you. Besides the 4 different stats I took note of from the Strategy Tester tab from TradingView, I also calculated the return over max drawdown ratio, a metric used by professional traders to assess the profits produced relative to the max drawdown, which is calculated by dividing the average annual profit by the max drawdown, where a higher number indicates better profitability and results. And then, by ordering the results using this ratio, the indicators that performed best in my in-sample data were the polychromatic momentum with the settings 20 and 5, then the copy curve with these settings, and in the third place, the Dora stochastic with these settings. Of course, other indicators performed well, but I just want the 3 best ones. Now, to confirm the effectiveness of these top 3 indicators and to discover which one is more consistent, I will apply them with the same risk management and across the same 5 assets, but this time to my out-of-sample data, which in my case is 2023. To do this, I simply need to adjust the data sample in my trading bot here and rerun the backtest for these 3 indicators, which will be very quick with the help of my trading bot. In the meantime, I would like to introduce you to XTB, the broker I use for trading in my personal accounts and investment portfolios. The great advantage of XTB is that it allows you to trade without any commissions and with almost zero spreads, making it one of the top brokers nowadays. Additionally, XTB is a proper regulated broker. To create an account, you can use the link in the description to support me. After applying the 3 indicators to my out-of-sample data, here are the results. And to compare all of them with the results from the in-sample data, I created this Excel sheet with the percentage differences from each stat by using this simple formula. In this case, we can see that all the results from 2023 were a little lower than those for 2022. But this is also due to market conditions. But the important thing is to analyze which indicator has the lowest difference in its results, and I will again base my decision on the return over max drawdown ratio. And so, in this case, the indicator that achieved more consistent results was the Dora stochastic with the settings 12, 18 and 11, which will then be my C1 indicator for this new strategy. For those who don't know, the Dora stochastic is an indicator that applies a smoothing technique to the standard stochastic oscillator, enhancing its effectiveness in identifying momentum shifts in the markets. It consists of 2 lines that fluctuate between 0 and 100, the DODA, the green line, and the DODA signal, the red one. When the DODA line crosses above the DODA signal 1, it means it can be a good opportunity to enter a long position. And when the opposite is true, it means the price may drop, and so it can be a good time to enter a short position. Simple as that. And that concludes our first episode of this trading bootcamp, where we have laid down the basic principles of what makes a profitable trader, and we started creating a new strategy from zero by testing and choosing our C1 indicator, which now we know is going to be the Dora stochastic. However, this is just the beginning. Over the next 4 weeks, I will publish 4 more important episodes that will complement each other. On the next one, you will discover how to get the most profit out of the signals from the Dora stochastic and one of the best risk management techniques you can use. So don't miss out. Subscribe and hit the like button to show me your support. Thank you, and I see you in the next week. Bye bye.